What's up everyone and welcome to today's video, where in this one we're going to be covering ICT liquidity concepts, what they actually are, the logic behind them, and how to engage with them. So I will first lay out what they are and define them, and then we will dive into some examples. So firstly, let's start by defining ICT's concept of liquidity. So there are two basic types of liquidity in the market. One is liquidity above old highs in the form of buy stops and early sellers. So by early sellers, I mean people who have already gone short in the form of retail traders, and they have their stop losses above these highs. I will dive into the logic behind that in a second, which is basic retail logic of support and resistance, and we'll dive into that soon. But the second form is liquidity above old lows in the form of sell stops and early buyers. So early buyers from retail perspective have their stop losses below support, and then they also have sell stops there as they want to trade breakouts. So if we dive into this example here really quickly to actually put this bit of logic into practice, you can see we have price react off this level here, and then it came down and reacted again and ran up. Now, retail traders will see this as support, so they don't want these lows to be traded below. They see this as support and an area of price which shouldn't be traded down into. Whereas with ICT's logic of liquidity and liquidity concepts, we know that their stop losses lie under these lows because they see it as support, and we also know that their sell stops lie below here. Now, why the sell stops lie below here? It is applying the exact same logic. So they think if we do trade below here, breakout traders now think we have a breakout where we should see something like this occur. We trade below the lows and then use it as resistance before going lower. Now that is what they think, when in reality something like this, applying ICT's liquidity concepts, will occur, where we do trade below. So they're right in the sense that they will be traded below, and then the support traders are wrong. We trade below and then something like this will happen, where we go and actually attack liquidity up here in the form of basic liquidity or inefficiencies in the market, which we'll get into. So they see this traded into twice, support, they don't want it traded below, and then basic liquidity says we should trade below old lows and old highs. So as ICT traders, we want to see these lows traded to and these highs traded to. And that is applying retail logic and then pairing it up with our logic and our trading style to, use it as almost opposites. So if retail are trying to go long, we are trying to go short or frame the market for shorts. Now let's start by actually looking at the retail logic of support and resistance. So retail see price react off this same sort of level 4 times. So we tapped in once, tapped in third time, fourth time before running away. Now what we see is sell stops below here. We know that people who are long and have longed this and are holding for, price up here. So people who are already long, their stop losses, where would they be? Their stop losses would be below either of these lows. So when we're trading up here and we have a logical PD array which is traded into, we want to see these old lows, of course partnered with a daily bias. We want to target these lows as our liquidity. So we're using the logic of retail going long to pair it up with our moves for shorts. So our targets for shorts would be down here. Let's say, for example, we saw price tap into this bit of price action here, came into the order block, and then ran lower past a low, create a fair value gap. We're going short from here with our stop loss above the high. We can then target the liquidity below here. This support of course it's not actually support, but what they see as support can be used as our targets because their stop losses lie there. And then the exact same thing I spoke about a second ago, where breakout traders will see this, we take this low down to here, they'll see this bit as a breakout. So when we zoom into this here, after dipping below, they want to see a retest before going lower. So a lot of retail are trying to go short here with their stop losses somewhere in this bit of price action here, and then they're trying to short it. But of course, as we know, using ICT's liquidity concepts, we will not be on side with retail as they're trading breakouts and we are trading the logic of liquidity. So after we trade below this low, they're trying to short, and then where would their stop losses be when they're trying to short? These invalidation points. Why? Because this is seen as resistance. So for example, this area here, where we tapped into twice, third time, fourth time, and then ran, these highs are also liquidity now. So their stop losses for shorts are also above these highs now. And then of course it's the same logic again as we trade above them, as you can see we are doing right now. They want to see something like this occur, where it's used like this, then a retest of this high or this high before going higher. Now, if they happen to get lucky and line up with a daily bias, then that may happen. However, if we are bearish on the daily, which I currently am, we will see something like this occur, and then they are used as liquidity up there. We enter on shorts and then target more liquidity down here. So this is applying basic retail support and resistance logic, and then framing our trades around that and framing our targets around that. Now quickly, I want to go over the retail logic of trend lines and how we use that to our advantage. So in this example here, of course their trend lines will not be perfect, but retail, if I get rid of this for a second, retail see this as a trend line. So we bounced off it once, twice, and then price hovers around before hitting it again. If I do that, hits it again, and then runs higher. Now pairing this with the logic of breakouts as well, as you can see above this high, they'll see this as a breakout. So when we moved off the trend line and broke above here, retail may want to see something like this, a retest of it before running higher. But if we pair it with our logic, we know below trend lines rests liquidity. So their sell orders to go short are below here, and their buys, their stop losses of those buys rest below these lows as well. So with that logic, we have lower highs constantly, and then another one on this trend line. And as you can see, notice how the trend line lines up with the bodies of this candle as well. That is actual volume in use, and then we have multiple bounces off it. So knowing that, we know that retail stop losses lie below all these lows in this trend line. So when we see liquidity taken here and a higher time frame PD array traded into, which is over here in the form of an order block, we have a daily order block traded into. We wick above the highs and then bring in the logic of time. As you can see down here, we have the London kill zone open. Again, this isn't a coincidence. We do this at the open of London, wick above, and then start to break lower. If you zoom into this price action, you can see we create a small fair value gap inside here, wicks into multiple times, and then during New York, mitigates it one more time before running below all these sell stops below here. The early buyers get run out by this price action. So they see a breakout and a trend line, whereas we see liquidity taken into a PD array, a shift lower, and then mitigation of a fair value gap before trading below all the lows and taking out all the early buyers and retail trying to go short. Again, applying the same logic, we can keep with one example. There are so many examples in one bit of price action because this occurs so much. You look over here, we have what the retail see this as we trade below. They see it as a breakout. So they will be trying to go short as we trade below on a retest of this area and this support as they see it, support turned resistance before going lower. Now you may be taught this in the books as well. You may have traded this way before you came across my YouTube channel or your ICT's concepts in general. And then as you can see, a lot of you used to go short at this point because we have a breakout and what they call a retest. However, as you can see, we are just taking sell stops and early buyers out the market before running higher and then eventually running as we currently are inside this fair value gap. Now again, this is literally applying the retail logic into the marketplace, and this is just a day's worth of, or a few days worth of price action, and you can see how many times the logic of retail is punished inside this marketplace. And this is just one example. This happens on all time frames all over the marketplace, every asset class. I believe this is how the markets are traded. So if you want to give yourself the best chance of becoming profitable, I would apply the retail logic. And then it sounds silly, but in essence, we are doing the opposite of what they're doing. Of course, with our own logic and the further understanding of ICT concepts, which I have plenty of videos on, explaining the deeper context and how to actually frame your trades so your stop losses don't get hit and other things like that. But if we apply the basic retail logic, it gives us a good understanding of what not to do and what to do. Now, for those of you who are a bit further along the ICT timeline and understand some of the concepts, you know, to a better understanding, I wanted to show you how we can use these concepts, pair them up with retail logic to actually frame our trades. So as you can see in this chart example, we're on the monthly time frame on AUD USD. And remember, price is fractal, so we can use all of these concepts on any time frame you want. Now, if you notice here, we have a fair value gap inside here. We've traded into a rejection block, and I would like to see price trade back up into here. Now, if we go down into the daily time frame, remembering what I taught you before about retail logic, something should stick out to you here. So these lines are the monthly fair value gap now on the daily time frame. Something should stick out to you here. If we look, we have a wick, another one, third time, fourth, fifth, plenty of times we mitigated this area. Now, if I move this off to the side, just to keep this in mind, and draw a box here like retail would do. So we draw a box. Why would they draw a box? Because they see it as resistance. So price reacts off this level many times. So they think it's a sensitive level, which clearly price reacted off and should not be traded to. However, with our logic, we traded into the rejection block. And now, because we want to see it mitigate the fair value gap, we of course look on the daily time frame and see a bunch of highs here which have not been tapped. Now, with that logic, we know that we want to see it go higher anyway. And of course, with the logic, we now give a confirmation of retail are also going short, which favors us. And if you look on the New Zealand dollar, you can see that we have an S&T at the lows, which gives us even more reason to predict that price will rally up above the old highs and take out them early sellers and breakout traders. So again, applying the logic one more time, this is what we want to see happen. We'll trade above the old highs into the monthly fair value gap. And what would retail want to see once we've traded above the highs? Of course, they will want to see previous resistance used as support. So they will see something like that, where the resistance over here is turned into support and then used to go higher. However, we know that that is not logical. And using our logic, we will see this. And why do we anticipate it going lower from here as ICT traders? Well, one, because we've traded above old highs. and taken out them early sellers and people going long have been put into the market. But also at the same time, if we go in the monthly time frame, we've had bearish order flow for a long time, for about a year now. AUD USD has been bearish and much longer than a year, but looking back on the past year, we've been bearish. Now, the bearish order flow tells us we want to continue going lower to trade past this liquidity down here. So if we head back to the daily time frame, our logic on this not going any higher once we've traded into this is the fair value gap holding before actually taking out these old lows back here. Now again, this is pairing up the constant use of retail logic with our logic. We take out these early sellers, and because we know there's a higher time frame perspective in terms of the monthly time frame, this is a fair value gap on the monthly time frame. So we want to see it react off here and then go lower. Whereas retail, of course, they want to see it used as support before actually reaching up into here. So that pretty much brings us to the end of the video. If you did learn something here, please do leave a like and drop a comment. Be sure to subscribe as I upload almost twice a week. You can find the link to my socials in the description if you want to connect with me over there. I'm usually posting more intraday stuff over there, so you can trade along with me and join my Telegram. And yeah, I will catch you in the next one. Thank you so much for watching. I'll see you again.